Hey, it's Matt Decker here with Leveraged Wealth Management. I'm going to tackle a couple of topics here today surrounding whole life insurance. So, the first thing that we're going to talk about is the dividend rate versus the internal rate of return. Those are two very different things and they often get confused. So, dividend rate versus internal rate of return. We're then going to talk about the impact of early loans on whole life insurance policies because I think that there's a lot of misconception out there about loans on whole life insurance policies and whether or not it's a direct recognition, non-direct recognition. I think that you'll see that none of that really matters in the long run because of the actual mechanics behind the policy. So these whole life insurance policies a lot of times are sold under the idea that you can take early loans. You can take money out of these policies early on to pay for things like automobiles, to finance business purchases, to invest in real estate. There's all kinds of different ways that it's sold or packaged as taking money out of these contracts in early years. It might be referred to as bank on yourself, be your own banker, infinite banking. Books have been written by people like Nelson Nash, Pamela Yellen. There's all kinds of stuff out there on using whole life insurance as a replacement for a bank, and I'm going to try and debunk a lot of that with just some really simple, obvious math that anybody can do, and in about 5 to 10 minutes understand that those concepts don't really work. So I said we were going to start with the difference between the dividend rate and the internal rate of return, and that one's really easy. So what you need to do if you own a whole life insurance policy is you need to ask for an internal rate of return ledger on your current policy. And what that's going to do is it's going to show you the actual internal rate of return of your policy for every single year. Now, what we're looking at here is a Mass Mutual policy. This is a 10-pay whole life insurance policy. It's one of their best policies. This particular company, Mass Mutual, has one of the strongest dividend-paying whole life insurance policies out there. They have for a really long time. So this is not a cheap shot at Mass Mutual. This is not me cherry-picking a bad company. This is a really good company in the whole life insurance space, one of the best, okay? This policy happens to have, they call it a 6.4% dividend rate. So 6.4% dividend rate. And what most people think when they purchase these policies is that they're actually getting 6.4% per year, okay? But if you know anything about how a dividend works, let's assume that you have $100,000 in Ford stock. If Ford stock declared a 6.4% dividend, you would expect to get $6,400 from Ford because you got $100,000 in, a 6.4% dividend. They take 6.4% multiplied by the amount of your shares, the value of your shares, and now all of a sudden you've got an extra $6,400. That's how a dividend works. It's based on how much money you have invested. I think what you'll see when we look at this is that it's nowhere near that. So the first thing we're going to do is we're going to look at the actual internal rate of return. So this is the internal rate of return report on the cash value. And what you'll notice is that it's a 10-pay policy, $14,000 a year. For those first 10 years, you'll notice that the internal rate of return is basically zero. It's negative for the first several years, and then it finally breaks even here between years 9 and 10. So this is the point between 9 and 10 where you've actually broken even and you have just as much in cash value as you've paid in premium. So for the first 10 years, there's really no return on this policy. That's pretty typical. You should come to expect that, okay? In fact, in year one, you paid in $14,000, you have $4,300 in cash. Extremely typical. There's not really anything wrong with that. That's fairly typical. But what I want to really key in on is looking for the highest internal rate of return percentage throughout the lifetime of this policy. So we go out to year 25, we're up to 4.27%. If we go to the next page, the highest one that I can find is 4.85%. And I believe that's going to be the highest. So 4.85% is the highest internal rate of return on this particular policy. And you'll notice that 4.85% is a whole heck of a lot less than 6.4%. Why is that? It's because whole life insurance is the most expensive form of life insurance you can buy. Why is it the most expensive form of life insurance you can buy? Because it has 3 guarantees, and guarantees are extremely expensive. You have a premium guarantee, you have a death benefit guarantee, and you have a cash guarantee. Every time you add a guarantee to one of these policies, anytime you add a guarantee to anything, it doesn't matter what product we're talking about. If you have a guarantee built into a product, it is instantly more expensive than not having the guarantee. So that's how you end up with a 6.4% dividend on a product that only has a high point IRR throughout the life of the contract of 4.85%. And if you want to actually just do this on a year by year basis, you can, and let me show you how to do that. So this is just your typical ledger page. There's nothing special here, but there's a really easy way to understand or to conceptualize the actual year by year return on the policy. Okay, so I know that these policies are front loaded with fees, and you've got your cost of insurance charges, and so some of you might think, well, internal rate of return over the long haul, that's not nearly the same as your dividend rate and what you're earning on a year by year basis. And I totally agree. So if you want to understand your whole life insurance policy and what you're actually earning year by year, it's really simple. Here's how you do it. So you're going to take any cash value, total cash value. So this is total cash value end of year. So let's just take this last column, year 21, age 50, 266,870. We're going to get our calculator. We're going to go 266,870. And all we're going to do is we're going to divide it by the previous year's cash value. And the reason we're going to do that, it would be more difficult if you were paying premium. This is why I chose the 10 pay, because we're not paying premium in any of these years. So all we have to do to get the rate of return from year to year is take 266,870 and we're going to divide it by 252,407. So 266,870 divided by 252,407. And what do we get? We get 5.7%. Okay, so in that 1 year, we had a 6.4% dividend, but our return year over year was only 5.7%. That's a whole heck of a lot different than 6.4. Okay, so keep that in the back of your mind. The lifetime internal rate of return at the high point, at the non-guaranteed projected value, not the guaranteed value, the non-guaranteed projected value was a high of 4.85, and the high point from a year by year return is 5.7%. Okay, so those two numbers are important because it leads into the next conversation about using this policy for loans. So here's what you need to do if you own a whole life insurance policy. You need to pull up the illustration that was originally sent to you in order to help make the sale. And you need to do a find. So Control F is going to bring up your find key. And what I want you to do is I want you to just search for loans. So you're going to search for loans, and you're going to search until you get to the point where it shows you the actual loan provisions on the policy. And there it looks like I just found it. Okay. So you notice I had to do that a few times because it mentions loans a lot in here. But this is key. Additional information about this illustration, and I'm just going to read it to you. Because if you expect to take loans on this policy, you have to understand how it works. And especially if you're in the be your own bank, infinite banking, bank on yourself mindset, and you think, I'm not going to pay interest to the bank, I'm going to pay interest to myself. If that's your mindset, you have to understand this because this is what you're doing. The fully allocated expense method is used to allocate overhead expenses for all illustrations, annual net outlays based on a tax bracket, None of that matters. This is what matters. This illustration, using a 5% policy loan interest rate, is for a policy issued in California on such and such date. This rate may change on each policy anniversary date. Okay, so that's key. This illustration is assuming a 5% policy loan, but that loan, it might change on each policy anniversary date. Now, why is that important? It's important because these policies, along with any insurance company, it doesn't matter if it's whole life, index life, variable life, doesn't matter. All these policies, their loan rates track with the Moody's corporate bond yield. The Moody's corporate bond yield for the last 5 or 6 years has been near historic lows, because interest rates have been near historic lows for years now. So if you have a policy loan interest rate that tracks with the Moody's corporate bond yield, or that tracks with, in a broader sense, interest rates in general, and interest rates have been at near historic lows for years, you should assume that if interest rates start to tick back up, this sentence right here, this rate may change on each policy anniversary date, you should expect that sentence to come back to bite you in the future. And if interest rates go up, you should expect this illustration using a 5% policy loan interest rate, that 5% is going to go up, it's going to change. Now, why is that important? It's important because if you intend to use this policy to bank on yourself, you have to understand that at this point, there's a baked into the cake 5% policy loan interest rate. That 5% charge goes to the insurance company when you pay back your loan. It doesn't go to you, it goes to the insurance company. That 5% charge can go up. But what's even more important than that 5% policy loan fluctuating, what's even more important than you not actually paying the 5% to yourself, it's actually going to an insurance company. What's more important is you have a policy with an internal rate of return lower than the interest rate being charged to access your money via loan. I'm going to say it again. You have a policy that has a lifetime maximum internal rate of return of 4.85%. Remember that? That's from the beginning of the video. We looked at the highest year IRR on cash, 4.85%. Yet, when you access your money in this policy via loan, you're already underwater. As soon as you take money out of this policy at 5%, they're charging you more than the internal rate of return on the policy, and you're underwater. So it doesn't matter if you're quote unquote banking on yourself. It doesn't matter if you're paying yourself back the interest. None of that matters. It doesn't matter if it's direct or non-direct recognition. None of that matters because they're charging you more than your policy's making to access your money. And this is symptomatic of every single whole life insurance policy that I've seen over the last 10 years. I nearly never see a whole life insurance policy that has a loan rate lower than the internal rate of return on the policy. And the reason that I'm showing you this Mass Mutual contract is because this Mass Mutual contract is actually a really good contract. It's the best one that's out there consistently year over year. And even the best one that's out there consistently year over year does not have an internal rate of return higher than your policy loan rate. And that's why, in a nutshell, I don't think that these bank on yourself concepts, I don't think that financing your business or purchasing a vehicle, none of those things works from a math standpoint in a whole life insurance policy. It works if you don't compare it to anything else. But as soon as you start comparing using this policy and these loan provisions to anything else, it doesn't work. And here's a great example. A couple years ago, I bought a new car. I went to my local credit union and I got a rate of 1.9%. So if I can get a rate for a new car at 1.9%, is it better for me to go to that credit union and get a loan at 1.9 or take a loan for my life insurance policy at 5? I'll pause for you to think about that. What's going to be better? A loan for my credit union at 1.9 or a loan for my life insurance policy at 5? Obviously, the answer is you'd much rather pay 1.9% to your credit union than 5% to your insurance company. It's a no-brainer. And that's why when you compare this to nothing, it looks good. When you start comparing it to other options, to other vehicles, when you actually compare it to getting a loan from a bank at a lower rate, it no longer makes sense to bank on yourself. So I just wanted to make this quick video because this is probably one of the more convoluted subjects in the insurance industry. It's probably the most misunderstood concept because some really influential people write some really good salesy books on the subject. And it gets a lot of people drinking the Kool-Aid. And I think if you just step back, if you ask yourself these questions, is my dividend rate my rate of return? No. Is my dividend rate my internal rate of return? No. Are my loan provisions better or worse than my internal rate of return? When you ask yourself those three questions, you'll understand that using these policies for early loans, it just doesn't work. There's a different place for whole life insurance. It's not for using it as a bank. because mathematically it doesn't work. You got to compare it to other alternatives. So anyway, I hope that helped. I hope that it shed some light on a really complicated subject. It's probably worth way more than a 12 to 15 minute video, and I might do something longer on it in the future with some actual numbers and policy examples and a big Excel spreadsheet. But for now, leave a comment below. Let me know what else you want to see on this channel. Let me know what other reviews you want me to do, what products you want me to review, and I can work on that as well. If you haven't done so already, like and subscribe, and I look forward to talking to you soon.